It's probably the most famous rule in all of personal finance, a single number that promises a lifetime of security. But is the 4% rule really a reliable guide for your retirement? Or is it a dangerous myth that could leave you in trouble? Let's dig in and find out. I mean, this is it, right? This is the one question that everyone who's ever saved a dime for the future has to ask themselves. It's the multi-million-dollar question that the 4% rule claims to have the perfect answer for. So here's how it works, and it's beautifully simple. Let's say you've saved up $1,000,000 reais. In year one of retirement, you take out 40,000. Easy enough. The next year, you take out that same 40,000 plus a little extra to account for inflation. You keep doing that, and the promise is your money should last for 30 years, maybe even longer. But where did this magic number even come from? To really get it, we've got to go back to its creation. And here's the most critical part. This rule wasn't designed for average sunny day market conditions. Not at all. It was born from a stress test. And just so you know, all the information we're looking at is based on a comprehensive research review we wrapped up on April 20th, 2026. Okay, let's look at the studies that started this whole thing. Okay, so what you're seeing here are the two heavyweight studies that put the 4% rule on the map. The first guy, William Bengen, was obsessed with one question. What's the absolute highest withdrawal rate that could have survived the worst possible time in American financial history? He called it SafeMax. Then the famous Trinity study came along a few years later and basically confirmed his findings, though they were looking for a high portfolio success rate. And this quote just says it all. The entire model was built to survive retiring in 1968, right before the U.S. got slammed with a decade of high inflation and a stagnant economy. Think about that. It wasn't designed to be the best rate. It was designed to be a survival rate for the absolute worst of times. But here's the problem. That very specific worst-case origin story is also the source of its biggest weaknesses. The rule is simple, sure, but the real world, well, it's anything but. Let's start looking at the major cracks in this model. The model just ignores some huge risks. First, there's the sequence of returns risk. That's a fancy way of saying if the market crashes right after you retire, you're in a world of hurt. Then there's longevity. The rule was built for a 30-year retirement. What happens if you live to be 100? It also doesn't really account for things like super low interest rates or fees and taxes that nibble away at your money. Or maybe the biggest risk of all, our human tendency to panic and sell everything when the market gets scary. So this brings us to the biggest question of all. This whole thing was built using data from the United States, a country that had, let's be honest, a phenomenal 20th century. So what happens when you take this rule and test it in other countries? Well, the answer from a massive study that looked at 109 years of data across 17 different countries is pretty stunning. It turns out the success of the 4% rule in the U.S. isn't the norm. It's a historical anomaly. Basically, it's an outlier. And just look at these numbers. In the US and Canada, the success rate is amazing, near perfect. But look at Italy. Your retirement plan would have failed more than 80% of the time. In Germany and France, it was pretty much a coin toss. This is some serious evidence that the 4% rule is not some universal law of finance. And if you want to really drive this point home, look at this. In Germany, a major global economy, the maximum safe withdrawal rate over more than a century wasn't 4%. It was a tiny 1.14%. Wow. Okay, so if the rule is really an American anomaly, what does the data say about Brazil? This is where the picture gets even more complex and, frankly, really fascinating. When we look at studies focused on Brazil, we see this huge disagreement. You've got a peer-reviewed academic study from a top university, FGV, suggesting a 5% rate might be sustainable. But then you have analysis from the FIRE community finding that historically, a rate over 8% would have worked. So what gives? Why is there such a massive difference? It really all comes down to their methods. The FGV study is academic. It uses sophisticated statistical models to try and predict a range of future outcomes. The analysis from the FIRE community, that stands for Financial Independence, Retire Early, is different. It's based on looking backward at raw historical data, but only from 1995 onward. And as the authors themselves point out, that's a pretty short period of time to be making huge, long-term decisions. And of course, Brazil has its own unique list of challenges that the original American model never had to think about. We're working with a really short window of reliable economic data, a not-so-distant history of hyperinflation, and way more institutional and currency volatility. All of that makes long-term planning incredibly tricky. So, after going through the origins, the global data, and the specific case of Brazil, what's the final verdict here? What should we make of the 4% rule? Well, you know who else doesn't believe in a fixed rate? Modern experts. Just look at the research firm Morningstar's recommendations for a safe rate over the last few years. It goes up, it goes down. It bounces around between 3.3 and 4%. This proves a really critical point. There is no single magic number that works forever. The right number changes with the markets. And this quote from some absolute legends in finance, including a Nobel laureate, just perfectly nails the central problem. Think about it. You're trying to create a perfectly steady, predictable income from a portfolio of stocks and bonds that is, by its very nature, risky and volatile. It's a fundamental mismatch. So what's the big takeaway here? And this is absolutely not a recommendation, just an insight from the data. The 4% rule is a fantastic starting point for a conversation, but it's a terrible final answer. The key is that any retirement plan has to be flexible. Static, rigid rules just don't work in a world that's always changing. Your personal situation, your age, your health, how much risk you can stomach, is everything. This is definitely not a set it and forget it kind of problem. If you enjoy this kind of deep dive, getting past the headlines and into the actual data on big topics and macroeconomics, AI, and technology, then we've got a lot more coming for you. Make sure you follow our channel, Macroeconomia, for more explainers just like this one. And hey, if you want to get nerdy and check the data for yourself, we've put links to all the original studies and sources we used right down in the description. And finally, the important bit. This material is for informational and educational purposes only. It is not an investment recommendation or any kind of financial advice. And please always remember that past performance is never a guarantee of future results.